Kathryn Schmeltz. Welcome to the show, the Capital Raiser Show. Super excited to have you on here. I love having women entrepreneurs on. I met you at the RMS, the Raising Money Summit, and you introduced yourself. We were having a couple of drinks, and you mentioned that you had done a few syndications, and your partner was in the room. I've gone and done a little research, found out that you originally started in the single family flipping world and have a background in construction management, and you've managed that side of things. So welcome to the show. Super excited to have you. Why don't you tell us a little bit about your background in regards to real estate and how you've come into the multifamily syndication space?
Sure. All right. Well, thanks, Ruben. Thanks again for having me. So nice to meet you in Denver at Raising Money Summit. I started in single family, but when I first going back to after I graduated from college, I worked for a company. It was a family-owned company. They owned and managed about 2,500 units. I worked for kind of like their sister arm, and they imported items from China. They imported like cabinets, sinks, light fixtures, faucets, flooring, stuff like that for renovations for their apartments. So I also worked with the owner of the company. I did everything from like property management. I did purchasing. Did the purchasing for all 26 apartment complexes that they owned. I did all the rehabs. I kind of like managed the rehabs, ran into the rehab guys, because we always had like, rehabs going on at all the different properties. And then so I kind of did that, and I worked there for about 5 years. So I learned quite a bit in multifamily space. And then from there, I realized, I wasn't going to move up in a family-owned company. So then I kind of was like looking for something else that kind of was still in multifamily and kind of could bring my background. And a mutual friend kind of hooked me up with a company called Omni Assessments that they do the due diligence in Dallas. I'm located in Dallas. So he does kind of all the due diligence for any investor that's acquiring properties in Dallas. And then the due diligence means that they do kind of like an inspection, kind of like a home inspection. It's like an inspection for multifamily. So we look at the roofs, foundation, plumbing, electrical. And so we kind of like worked with the different trades to kind of let them know how good or bad the asset's looking when they're looking to acquire it. So I did that. And then while I was working for them, Brian, who's the owner of Omni Assessments, asked me, hey, you should go to this weekend event kind of to talk about multifamily investing. I think it'd be good for you. So I went to that event and, learned all about syndications and investing and passive investments and stuff like that. And that kind of like opened my eyes. He also told me to read Rich Dad Poor Dad, which I've never even heard of the book. But after I read the book, I realized, oh my gosh, like this is just a whole nother world, and kind of like opened my eyes and light bulb went off. Right. And so at the same time, I was working with my partner now, who you met at the event. We were flipping homes. And so it was pretty much like a passive investment through him. He kind of was flipping homes, but would run out of his own capital. So he needed to borrow capital to put the down payment on to flip a house. So he asked me and my husband if we would be interested in giving him some money to flip more houses. So we would give him money, and then he would do all the sweat equity. He would fix it, sell it, and then he would split the profit. So then I realized this is literally passive investing to a T. I just gave him money and then I got money back. So then I decided to do that full time. We flipped, over 100 houses. We've been doing it since 2013. Made a lot of money doing it. But then, we usually would get like, it was just getting so easy, right? And then we would make money on every deal. We never lost money. But then there was one house where it just got saturated. There's a bunch of flips that got on the market at the exact same time we put the house on market. Ended up not having the leverage, and lost some money. So that kind of like catapulted us back into, let's get back into multifamily. I always knew I wanted to do multifamily, but I thought I kind of had to build my track record. And so I was like, all right, we built our track record, we made money, let's go back into the multifamily space. So we kind of joined up with that same mentor that I went to his 2-day event, and kind of started with that and started getting into syndication. It's kind of kind of like my background and my like transition into multifamily.
Yeah, it's very similar to what Bakerson did. We were flipping a lot of houses using hard money.
Uh-huh.
And then we got introduced to somebody who said, you guys are really good at what you do, but you guys are paying way too much on your money. Why don't we teach you the syndication? Actually, a gentleman named Joel Block, whose event I'm going to this week, on Sunday it starts. So he basically goes over the syndication process and how to create hedge funds and how to divide up slices of equity and then sell those to investors, kind of almost like a security, which is essentially what syndication is. So you start going into multifamily. Tell us about, did you first do a couple of joint ventures and then do your syndication? Or I know that you had mentioned that the deal that you're currently working on is not a syndication, but let's walk through some of the deals that you've done. Tell us about them, if you can recall.
Yeah. So when we realized we wanted to go into apartments and multifamily from the single family space, it was kind of interesting. Somebody that we knew through the single family space told us, we started putting out in the atmosphere, right? We're looking at buying multifamily now, not single family. And, so we just started talking more about it. And so somebody that we knew said, hey, I have a 26 unit apartment complex in Dallas that I'm looking to sell. Why don't you look at it and see if you could buy it? So he gave us the purchase price, what do you want to make? So that was kind of like our first run at it, from like analyzing it and underwriting it and trying to figure it all out. And, it was kind of pretty good because he was like, I have no offers. It's literally off market. It's direct to owner. See what you can do. So it took us a while to figure it out because we had to call management companies and understand how to put it all together. So it took us a few months. But anyways, when we're going through this process, we're looking at comps, and one of the comps, like a direct comp to this apartment complex, I realized was somebody that I knew through multifamily. I actually did work on one of his other apartment complexes, and when I did the construction management side, so I knew him very well. So I called him and I was like, "Hey, I'm looking to start being an investor in multifamily. And I look at your comp and it's direct comp." He's like, "That's so funny. You called me because I literally sold it last week." Or maybe it was like 2 days prior. It was just a very weird time that I called him. And then we started opening up the conversation. Hey, so you're starting to invest. Like, I told him that I'm part of this mentor program that he used to be into. And so kind of like open lines of communication. Well, he ended up finding a deal about 16 units in Grand Prairie. And he called me. He was like, "Hey, I have this deal under contract. How about you do everything? I know that you can do it. And I'll just, we could work together." So of course I brought my partner in on the deal. And then he brought one of his other partners in on the deal. And so we kind of like all kind of came together, just the four of us, and we bought it through one of his LLCs he already had available. And we kind of all put our names on the LLC and bought this property. So it wasn't a syndication. But that was kind of like our first deal. It's actually on the market now, so it's almost like a full cycle deal. But that kind of like catapulted us into actually being a player in the space. And then from there, we kind of, I guess it's kind of like what your track record is, right? And then we found another deal in Lubbock, Texas, which I said I went to Texas Tech University, which is in Lubbock. My partner went to Tech as well. I've known him since college. So a apartment came up in Lubbock, and we got super excited. We knew the deal. We knew Lubbock. So we just jumped in our car and looked at it and really liked it. So we started putting that together and then kind of brought our partners in on that. So it's the four of us. And then we syndicated that. It's kind of how we like got into the syndication.
So then when you decided to do the syndication, you knew that you would have to have a lawyer create some documents for you. How did you decide? How was that process for you when you're joint venturing or doing a TIC structure or doing some kind of just basic, a couple of investors into it, and then you make the switch, right? You take that next level. Now you have a lawyer involved. What was that like?
Yeah. So, so the first one was super simple because the guy kind of walked us, held our hand and walked us through it. But the second one, which was called Courtyards on the Park in Lubbock, it's 103 units. I think it just goes back to having a mentor. I mean, we spent a lot of money to be part of this ecosystem and mentorship. And so I think they kind of tell you like, okay, you write an LOI, and then when you get accepted, then when you get the LOI accepted, because you just kind of, you know, write something super basic. You don't really need a lawyer to review it. They kind of help you just write like a super basic little thing, and it's not binding at all. So you send the LOI. Once you get it approved, then or when they say yes, we want to move forward, then you do the PSA, and then at that time you kind of get your lawyers involved. And what's good about having a mentorship, or at least for the mentorship program that I joined, they kind of are like, all right, if you need a lawyer, then this is your lawyer. If you need a, you know, anything, if you need a lender, this is your lender. Like, and it really kind of, because there's so much noise, you know, I get emails all the time from the lenders and different attorneys, you know, so it's nice just to know who to go to, at least for your first deal, and not have to Google it, you know. And so the lawyers that we work with is Calliser, and they're located here in Dallas, and they're super simple to work with. But yeah, we pretty much like, I mean, we're newbies, right? So we lean on them to hold our hand, and they put together a PPM and subscription agreements and all the documents you need to get LPs to get in on your deal.
And then, so once you have this agreement in place, you have the deal under contract, the next step is raising the capital for this deal, right?
Yeah.
So how did you guys go about that? You guys went to your friends and family, or it was I'm guessing it was a friends and family type of capital raise?
Yeah, so our capital raise was a 506B. So it's you can only raise from friends and family, people that you have a substantial relationship with. You can't just go out and solicit to anybody and everybody. You can't put it on Facebook, anything like that. So, yeah, I mean, luckily, since we're in the single family space and we borrowed other people's money, once we started flipping a lot of houses, our capital can only go so far. So we started using, you know, one of our friends to start using their money. So we kind of understood, you know, leveraging other people's money a little bit. So that guy wanted to invest. Obviously, we have a good track record with him. But throughout the whole process, I mean, a lot of people, you know, if you're making moves and doing things, and other people are like, I want to get involved. How can I get involved? I want to, you know, give you guys money and split the profits and do all that. So we had a lot of people that wanted to get involved that we could never figure out how to do it. So we, of course, went to those people. That was about half of the raise, I think, was from people in the single family space that we know, like, and trust. I mean, that's how you raise money, is people need to know you, people need to like you, and people need to trust you. And so I think we've, you know, through being in the single family space for a while, I think we've kind of gained that know, like, and trust, and people trusted us in this venture. But then we were part of the mentoringship, and part of it is an ecosystem. And with the ecosystem, you meet a bunch of people that are like-minded. And, you know, since you do have even though it's not multifamily, I mean, we did have multifamily experience. We had the 16 unit, but we had a pretty good track record on the single family and flips and understanding the business. And so a lot of people in that space are W2 IT, or, you know, W2 engineers or something like that. So I think we had a little bit more knowledge on real estate and construction and finding deals and understanding how to analyze deals and the numbers. And so I feel like we got pretty good know, like, and trust from the people that don't really know. They know us, obviously we need to have a substantial relationship, but don't know us for years and years and years, you know, like some of your other people from the single family space.
And then, so this deal, you're talking about your second one, which was 100 plus units. Did you manage some of the construction there too, or how did that work?
Yeah, so our first deal was pretty challenging. We bought this deal, you know, again in Lubbock. We know Lubbock market pretty well. We're really comfortable with it. But it was 50% occupied, which is kind of unheard of in multifamily, because most multifamily, that when people sell it, they want to be stabilized, so then they could get, you know, top dollar for stabilization. But this property, he ran out of money. I mean, it was a sinking ship. So when we bought it, it was super distressed. Our rehab was, over $700,000. It was like $7,000 a door. Um, so I did all the management of the rehab. So we did like LED lights. I mean, we did a huge renovation for the interiors. We just spruced everything up. We bought pool furniture. I mean, we just made it from like this distressed blah asset to kind of popping. We completely rebranded it. I mean, it had a really bad reputation in town, so we had to like refresh it completely. And the management company, I think they had like 5 different management companies that all kept saying it's a new property, but it was still the same owner. So we just kept running in, not running into the ground, but just didn't put the TLC that it needed into it. So we completely rebranded it, and now it's like an 84% occupied. We owned it for about a year and a half or so, a little bit less than a year and a half. So we went all the way from 50% down to I think 39% occupancy. So I mean, it was rough, and we obviously put like a bunch of money into, because we knew it was going to be negative at NOI because there's only 39%. So we underwrote it correctly, but now we're just starting to finally get up to stabilization. So it's been kind of a little bit of a different road than I think most people are used to.
Yeah, I think a lot of people do this. They like stabilized assets and then they fix them up a little bit at a time.
Yeah.
But when you have a deal like that where you go into a low occupancy status, that brings up the issue of how do you pay your investors? A lot of times people are interested in receiving a quarterly distribution, but if the property's not cash flowing, how did you address that with your investors?
Well, I think there's just so many tax benefits right now to investing in some of these distressed properties. And that's kind of like our bread and butter is we've taken, we flipped a lot of houses. So we have the vision of taking a really distressed, ugly looking property that everyone looks at and can't see past, the trash everywhere and the broken walls. And we have the vision, I think, to see past that, which I think a lot of people didn't have the vision. And so I think we kind of just having the flipping homes as our background, they understood that we did really have a vision. We obviously had to talk about the vision and talk about how we were going to get there. And we had a map to get there, but we told people, we set expectations. I mean, we told them, we're going to lose money. We're going to have a negative NOI for a while. Don't expect a distribution until at least after the first year in the second quarter. So a year and a half, at least, you will not get anything. This is more of a bump at the end, not so much during, and hopefully get out sooner than anticipated is kind of, and so a lot of people have different, thoughts. Like some people just want cash flow because they literally live off the cash flow from the passive investments. And then other people have enough money or have a regular job to where they don't need that money, but they see more value at the end to double their money, rather than get cash flow throughout and then a little bit of at the end.
So then from there, you go out and you do another syndication, and now you're doing a TIC structure. I think you had mentioned that you're going to be doing a 1031 into your next property. Mm-hmm. Tell us about what you got going on.
Yeah, so since that property in Lubbock, we bought another property, 116 units in San Antonio, which was another syndication, which we raised money. But then we actually we're under contract buying another property in Lubbock that we are going to 1031 our 16 unit in Grand Prairie in Dallas into 120 units in Lubbock. So we're working on that right now. We actually have the 16 unit on the market right now. The timing didn't really work out exactly as we planned. So we're going to have to do a reverse 1031 because typically you sell a property, get the money, and then you have, so many days to identify a property and to 1031 the gains into the next property. Mm-hmm. However, that isn't going to work out exactly as planned. So we need to close on our other deal in Lubbock fairly soon. And so we can't really wait around for it to sell. So we're doing a reverse 1031, which we're in the middle of it right now, and we're still learning more about it. But you, with the reverse 1031, you can actually buy the property without selling the other property. You just put you buy it in another LLC that the reverse 1031 company owns, and then you do a second lien on the property you're selling, and then you have, I think, 180 days to sell it to then put it back in. We're still learning more. I mean, we're in the middle of it right now. It's a little bit confusing, and we're learning more every day. But that's kind of how we're doing it. And we're going to do it. We have that under an LLC, but we're going to change that into a TIC, which some of the benefits of doing a TIC is that we can 1031 that for forever. Say we don't, our partnership of us four, if one of us decides, hey guys, I just want to cash out, I'm done 1031ing it. Well, that doesn't mean we're done. We can all 1031 it. I can 1031 into a deal in Denver, and then my partners can 1031 their money into a deal in, Florida or whatever. And so it kind of gives you more flexibility because you're all individual TICs, which is a tenant in common.
Yeah, makes sense. I've heard that from a lot of people. I know some people that are doing TIC structures here in town. So you guys really like Dallas right now. All of your deals have been in Texas or somewhere close to where you live. Is that the market that you guys want to continue to invest in, or are you looking at other places?
Yeah, I mean, we love Lubbock. I think that's a really good market. Dallas is really, there's a lot of competition in Dallas. We really like Dallas. We're still looking in Dallas. We've got the 16 unit, but we haven't gotten anything else here. But we're focusing a little bit more on Dallas now. And then also Dallas is a lot of hard money, because a lot of people are kind of blowing their way with hard money here. So I think we wanted to have a little bit of stuff under our belt before we came in and try to take down a 100, 200 unit apartment complex here. But I think we're ready to come back into the space. We like San Antonio. Really we like Texas. People have been asking us to, co-sponsor with deals in Oklahoma and some other places. And I really like Texas right now. I know Arizona, I heard that that's a great market. I wouldn't mind looking over there, but I think, you kind of have to define our criteria, and our criteria is Texas right now.
So you have a specific corridor that you're looking in. I thought I saw that on your LinkedIn. Or did I read that correctly?
Yeah, probably the 35 corridor. Yeah. Yeah. San Antonio. So our property's a little bit north of it's San Antonio MSA, but it's called Universal City. So it's a little bit out of San Antonio, but it's pretty much like a suburb. It's like Scottsdale to Phoenix,
Gotcha.
But yeah, Texas. That's where it's at right now, I think.
Yeah, there's a great market out there. There's a lot of similarities, some differences, but typically there's a lot of pressure, some compressed cap rates, a lot of people moving in, a lot of job growth and job diversity, and new people coming in, and even some rental growth. And then, but you guys are a little bit more stable than we are, because we have some major fluctuations at times. And we've been growing our rent growth. I think we've been number one in the nation, or in the top 2 or 3 in the nation for rent growth for so long that people are just like, it can't grow that fast for forever. Eventually there's got to be a correction. So
what's funny is my husband, he goes to Phoenix quite a bit, which is recent. He just got a promotion, and so he's now in Arizona, which he used to not be. And he has fallen in love with Phoenix and Scottsdale. And he's like, Kathryn, you need to start investing in Phoenix. It's killing, right now it's killing, and all I see is cranes and new things going on. I'm like, that's what I keep hearing,
There's a ton of apartment construction here, and it doesn't seem to be slowing down. There's just within a few mile radius of my house, there's probably between 5 and 10 new apartment complexes that have been either under construction or are popping up right now, or have in the last year or two.
Wow.
So when it comes to you, so we had a little conversation at the RMS about 506B versus 506C. And you were one of the few people that I talked to that really is bullish on the 506C type of capital raise. Is that your stance?
Bullish on the 506c.
Tell me why you like that.
Yeah, I think, I think like as far as so, we're in a mentorship program. We have this ecosystem. Everybody right now, when I first joined, it would be about 75%. This is back in 2013. It used to be 75% passive investors, 25%, active investors, which are the syndicators. There's so much, people just throwing money, but now it's kind of done a little change where not like 90% of the people in our ecosystem are now wanting to be syndicators and are signing on loans and trying to be part of the GP, group. And so it's kind of changed where a lot of people want to be the main guy, and there's not so much passive investors. And so it's been a little bit more challenging to find deals inside of your network and your ecosystem, because I feel like, I mean, just me, and I'm sure I'm not on half the email blast that other people are on, but I mean, I'm getting 5 deals a week. I mean, and they're not just like $1 million raises. I mean, some of them are $5 million, $10 million raises. And so you're competing within the same group of the like-minded individuals for that money. And so I think, I haven't done a C. I mean, so I don't know, but I see the benefits of doing a C, and I've seen a lot of people going into a C compared to a B. That's been kind of what everybody's been doing. I mean, I was looking at some stats from like a year or 2 years ago, and it was like 99% of all the syndications were a 506B. And now I feel like half of the deals I've been seeing going through my emails are going to C's. 506Cs, where you can market. I mean, if you're a good marketer, I mean, you could potentially, get more investors. But I do like just the simple 506B though, because I do like keeping those relationships. I like having people coming to me. Like, I really like sharing my knowledge, and I like having people coming to me, asking me questions, and just keeping that line of communication. Like, I really like being able to touch and feel investors. And sometimes it makes me a little bit nervous about the 506C, where you technically potentially don't know them and they're investing in your deal. I could see that being kind of a weird situation. But again, I haven't done it. But, I like knowing these people and knowing if things are going a little bit sideways, or if we have to have a conversation like, hey, by the way, this happened to the property. It's not sending this email to a complete stranger. It's like, they know who you are. They know you're going to fix it. They trust you. I mean, that's the reason why they invested with you. So
Yeah,
I
you
get
get
the benefits to both, right?
Yeah, even in the process of going through a 506C, you end up creating a relationship with these people, and you stay in communication, and then potentially do deals with them down the road. But with the 506C, for somebody that's transitioning from 506B to 506C, I think this is where it becomes interesting, because for me, and the whole reason I started the show, is I want to master the concept of raising capital.
Yeah.
And then, so if you've never done a 506C and you're coming from the 506B space, for example, if you run out of friends and family capital,
Yeah.
now you have to figure out how are you going to market in such an effective way so that you can attract this money.
Yeah.
And for me, I'm finding that some of the best things that I'm doing is to incorporate some people that have already done it and use their systems. In some cases, they have programs to help you with that. We're trying to come up with some really cool concepts through our company so that we can not only raise money for our own deals, but have the power to raise money for some other people's deals. Because like you said, we're interested in doing some co-GPs as well, whether we bring capital or some other things to the table. But you yourself had mentioned on your LinkedIn that you were interested in doing some co-GPs, or that's available. Can you tell us a little bit about how you think that might work, or what is your vision for how you would work with somebody in a co-sponsorship opportunity?
Yeah. So, right now it's close to the end of the year. And so we've been kind of trying to figure out how we're going to structure moving forward. We obviously want to scale, and we have quite a bit of deals going on. Like we're closing this deal in the next few weeks, so we'll have another one under our belt. But once you have 4 deals, you start to realize like you do a lot of work, and so we're trying to structure if we should bring someone on in-house, if we should start, sponsoring with people and helping with the workload. It's just, I feel like what we have going on is a really good team. So I don't want to rock the boat, but, you have to figure out something else to scale. I mean, so yeah, I think right now we're kind of leaning towards hiring somebody in-house that can kind of help free up some of our time. And then once we kind of get that under our belt and understand how we all work as a new team, because we're hiring someone internally, then we want to go out and potentially co-sponsor with other people, boots on the ground, people bringing us deals and just kind of helping share the knowledge is kind of how we're thinking to potentially grow and to potentially work with others. We're still trying to figure it out right now,
Yeah, no, I get it. We're all learning and growing
The work in
simultaneously.
process. Yeah.
It's definitely a work in progress, and that's a good thing. Those are good problems. Those are what I call champagne problems, where you're trying to figure out, you're in the business, and that's the most exciting part. So now, how do you get stronger, better, faster, and everything else involved with mastering your craft at a higher and bigger level, especially when you're trying to scale.
Yeah, and like we want to scale, but at the same time, like we're in it for the long haul. We're not trying to go nuts and buy all these deals and know that we can't manage it. So we want to be tactical and do things in a manner to not overload ourselves to where we can't. I mean, at the end of the day, people are trusting us with their money. I mean, we don't want to try to just buy everything we possibly can get, because we get a lot of deal flow coming to us. We actually walked away from a deal not too long ago, because at the end of the day, like we want to make sure that when we're doing things with everyone's money. We just want to make sure that we're not jeopardizing anybody's money. We want to make sure that we can handle the load and do it the right way. And if that means we have to go slower right now until we figure it out, then that's what we're going to do,
Makes sense. Very good. Well, I think that's going to do it for this show. I've had so much fun talking to you. You're a wealth of knowledge. I love the construction side of you, and that you're very focused on your specific niche, and I love the way that you take care of your investors. And the thing that I really enjoyed most about this last segment, where you're talking about being very careful about, you're managing your people's money. So you want to scale, but you want to do it in a very methodical way so that everybody's protected. And I thought that was very cool.
Yeah.
But I don't know when I'm going to see you at the next event. I wish I would have got a selfie with you. I guess it's going to have to wait until I come out there. I know Brad Sumrock's got some stuff going on, I think in early December or January or February, sometime in the next quarter. So I might head out to Dallas and maybe we can have lunch or hang out a little bit.
Yeah, I'd love that. Yeah, definitely hook up with me if you come down to Dallas.
I definitely will. There's a few people that I met that have some huge portfolios down there, and I'm not in the Brad Sumrock community, but I know a lot of people in it, and you guys are all super high caliber, so I respect that community big time.
Cool.
But with that, we'll sign off, and then we'll get to know each other a little bit more on the next one. Definitely, maybe we should talk a little bit offline about the opportunities to potentially work on some stuff together.
Yeah, I'd love that.
All right, cool.
Awesome.
All right, well, thanks for coming on the show. Yeah, you bet.
Okay, bye.
All right, take care.